All right, thanks everyone for joining us. I'm Carey MacRury, a senior gold analyst at Canaccord Genuity. It's my pleasure to introduce Frank Giustra. I'm sure many of you know he's a longtime entrepreneur, philanthropist, gold watcher, gold investor, and he's the CEO of Fiat Group. So welcome, Frank.
Thank you. Thanks.
So maybe to start, if you go back 20 plus years, early 2000s, gold was in a bear market in the 80s, the 90s. You were writing about gold in the early 2000s, investing in gold. So number one, what did you see in gold? Obviously, that was ahead of a huge bull market. So what did you see? And secondly, did people think you were crazy?
Yeah. I started to pay attention to what was happening with gold in around 1999, and by 2001, I developed a thesis, and the thesis was quite simple. I'd seen a couple of changes taking place that led me to believe that the US dollar was overpriced and gold was underpriced. And my thesis was based on the fact that the US was running big current account and trade deficits. They were consuming more than they were producing. The debt was piling up. And I could see the patterns that were starting to take shape that reminded, I'm a history buff. So I started to look at patterns of previous global powers and their rise and their demise, and they all follow the same patterns. And this is what Ray Dalio wrote about in his book a couple of years ago called The Changing World Order. If you haven't read it, read it. He did a lot more detailed explanation of what I wrote about back in 2001, but it was basically all the things were starting to fall into place. You had a Fed chairman and Greenspan that became the market darling. They called him the maestro because every time there was a mini crisis, he came to the rescue. And I think his ego got out of control, and he wanted to please Wall Street. So it was this concept of cheap money to solve every crisis that came about. And then 2001 happened, and 9/11 happened, and that changed everything. And that's when President Bush, at the time, went into the guns and butter and free money for all concept. And that really, and then started the war on terror, which you knew was an unwinnable war. And I wrote about this in 2003, just on the onset of the invasion of Iraq. And I said, this is a huge mistake. They're not going to win anything. They had already gone into Afghanistan, and it's going to cost a lot of money. And this is exactly the same mistake that every major power makes when they're a global power. And they spend their money on too many wars. It's overreach all the time. So my thesis was basically that the dollar was going to go down, it was overvalued, and gold was going to go up. Gold at the time was $250 an ounce, if you remember, in 2001. So I wrote these papers, I put them out there, published them, and then I did a roadshow with a fund manager named Frank Holmes, who was also a bit of a gold bug, US Global. And we went around, we did a roadshow just to talk about gold. We weren't selling anything. So we did a roadshow in Canada, the US, and Europe. And basically, it was like we were the deplorables, the heretics. We were laughed at. People ridiculed us because they just thought, what are you thinking? There's no reason why gold's going to go up. And then, as you might all remember, this is when gold started its very gradual, as I say, climbing a wall of worry, which every bull market starts with people not understanding, not believing. And it didn't happen overnight. Gold went from, in 2001, it went from $250 an ounce to 10 years later, it hit $1,900. It didn't happen overnight. And so at that time, no one could conceive the idea that gold was going to go that high. It was much like if you were sitting in 1971, if I was sitting here, it was 1971, gold's trading $35 an ounce, and I'm going to tell you that in 10 years, it's going to go up 25-fold. You would think that I'm crazy. And by the way, this is where we're at today. Today we're at a new high, which has now been established finally. It took longer than I thought, but we've established a new high. And if someone says to you, gold's going to go up 8-fold like it did in 2001 to 2011, or 25-fold like it did in 71 to 80, you'd think they were crazy, right? I think we're in the beginnings of the third phase of the bull market that started in 1971 when the US dollar went off the gold standard. And this phase will be explosive. And people sitting here will not believe it. You will not believe it. And you'll have to wait and see. And I think that if you have conviction today, fortunes will be made. But you have to have conviction, and you have to understand why gold's going to go up. And there are some very good reasons why it's probably going to go up a lot higher.
So to your point, the Pueblo Viejo mine run by Barrick, there was a sliding scale royalty, and this agreement was probably written in the late 90s. Sliding scale royalty, maximum gold price, $350. So nobody can consider a 20-year mine life with gold above 350. Anyway, so here we are today, hitting all-time highs, 2,300. You know, there's a lot of commentary on what's been driving the gold price. What's your view on what's happening today?
Well, I think the main thing that has happened that a lot of people haven't understood yet is that the price of gold is no longer controlled by the West. See, for the longest time, we had a situation in the world gold markets where gold was consumed in the East but priced in the West. That's changed, and it changed just very recently. China now controls the price of gold. And the reason they control the price of gold is because they bought a lot of it, much more than they've declared officially. They're the world's largest gold producers. They're the world's largest gold importers. They don't allow any export of gold mined in China. You can't export gold mined in China, it stays in the country. And the part that people like us that run around the world financing gold mines are seeing is that they're running around the world buying gold mines. And their attitude is, why pay retail when you can pay wholesale? You can buy all these gold mines, get your gold at $1,100 an ounce, and it's a nice blend with everything else you're doing. So I believe that China and others, and it's not just China, but China is leading the charge, is now setting the gold price. And you're seeing that all the central banks around the world outside of the G7 are selling US dollars and buying gold. And that's been happening for 14 years now. And now it's accelerating. You know, their gold purchases are accelerating. So you're going to see a situation at some point where gold is going to play a role in whatever the outcome is with the global monetary system reset, which is going to happen at some point.
So obviously the Ukraine-Russia incident happened. You know, it's kind of unprecedented for the West to seize a central bank's assets. I'm assuming that plays into the mind of China, Saudi Arabia, et cetera.
Especially China. You know, they saw what happened to Russia, and obviously China and the U.S. are not on friendly terms. And there's a potential of conflict there at some point. So you started to see how China started unloading all of their treasuries. They're down to $750 billion now from over, they were at 1.1 trillion at one point. And they're replacing that with gold. And then the rest of the world is following suit. And you're seeing it every day. We watch the numbers very closely. And every country around the world, the global south, all the emerging economies, are all de-dollarizing, selling their dollars, and buying gold. Now, they're not only doing it because of the sanctions fear, although that is a huge concern for the likes of China and others that are unfriendly with the U.S., but they're doing it because they're watching what's happening with the Western economies and the levels of spiraling debt that are not. All the Western economies have too much debt. There's no control to reel in that debt. And at some point, you're going to get a fiat currency crisis. It might happen in Japan first. It's already starting in Japan to unravel because they've had this bizarre monetary system experiment that is just unbelievable how much money they've printed to, maintain their economy. But I think you're going to see that happen with all the Western fiat currencies. They're all in too much debt, and there's no discipline. All fiscal discipline's gone out the window. In the U.S., you've got a broken political system that can't agree on anything, never mind. And they don't even talk about deficits. They mention them, but no one has any concrete proposals because they know they're screwed. If you look at the makeup of the U.S. federal budget, 76% is made up of non-discretionary spending, means you cannot touch that by law, and interest payments to pay on the $34 trillion of debt. They're boxed in, and there's no discipline, and everybody, the Democrats love to spend, the Republicans love to give tax cuts. No one's addressing the deficit issue. And they're heading towards a cliff. And the world is starting to see that.
And funding two wars. And funding two wars.
And funding two wars because it's the military-industrial complex. They want to keep the wars going. They basically have influenced Congress. They can get away with anything in terms of wars, and no one ever confronts them. So you've got a situation where the world sees this unraveling on the horizon. And who knows how long it's going to take? It could happen tomorrow, or it could happen 5 years from now. But we're heading in that direction. You got $34 trillion of debt, going up by $2 trillion a year at the least, for as far as the eye can see. And this is the CBO predicting this. Yep. $100 trillion of baseline deficits, CBO again, over between now and 2050. 5% interest rates. How are you going to service that? That's insane. There's no way. It's unsustainable, and it's going to come crashing down. So I think that the rest of the world is preparing for some change, and you're already seeing all of the talk about BRICS currency and this and that and the other. But everybody's trying to get away, reduce their dollar holdings, and increase their gold, because gold is the only neutral asset in a portfolio. It's money, but it's the only neutral money that can't be printed and isn't someone else's liability, and it can't be confiscated as long as you have it in your own country. So everybody's waking up to that fact, and you're going to see this trend continue. They're going to continue to buy gold and sell dollars, and that's going to have some blowback that we can talk about if you like. This isn't going to be a smooth ride, because the U.S. is not going to. They're already making comments about punishing those that don't use dollars, to try and exit the dollar system. But it's happening, and they can't do anything about it, because you got 85% of the world's population wanting this change, and they're all instituting different ways to change it.
So, the U.S. and China have become so intertwined. You look at Apple's supply chain, you go into stores, 80% of stuff is made in China. Can China and the U.S. really decouple in the big picture?
Not unless there's a war. If there's a war, yes. If there's ever a war between China and the U.S., which could happen, they're both trying to avoid war, but they're taking there's a lot of muscling and going back and forth. If there was a war, yes, they would completely decouple. Otherwise, it's going to be very, very difficult. What you're going to see is onshoring and friendshoring, mostly friendshoring. And so, and they're going to compete over high-value technologies. That's where the competition is going to take place, not in the low, value tech industries. So you're going to see fights over electric vehicles, over solar panels, over anything that's high-tech. They're going to fight over and try and remove from each other's sphere. Mostly the U.S. trying to remove from China's sphere, but. And I think that that's just going to continue, and the world is deglobalizing and is falling into at least two camps. And there might be more, but you're going to have a world with two camps, each with their own trading relationships, and that's where we're headed.
So Tony Dwyer said at lunch, obviously the U.S. economy is very mixed signals, weird picture. It's hard to know if you're bullish or bearish. Obviously there's the no landing camp, the soft landing camp, hard landing camp. The Fed's raised interest rates at historically a fast rate. What do you think about the U.S. economy and what the Fed does here?
Well, I think that the Fed created an inescapable trap in 2008. And I wrote about it back then. I said, when the crash happened in 2008, there were a lot of people that were concerned, and I know some very, very important investors in New York, very famous names, one in particular, that were concerned that we were going to go into a depression in 2008. And I had a debate with them. I said, that's not going to happen, because you're going to see this money printing, which is going to create a floor on the economy, but we'll pay for it later. But as soon as the printing started, I said right away, there's no way to unwind this now. You've gone too far. And then obviously 2020 happened, and they went even further. They're screwed. I don't know. They can't, Bernanke said he was going to unwind the balance sheet in 2009. He says, yeah, sure, we're going to create all this money, but we're going to unwind it in a couple of years. Here we are, 15 years later, and it's still at $7.5 trillion from $9 trillion. And now they just announced that they're going to slow down QT because they know they're screwed. And at some point, the world's going to stop buying treasuries. They already are. And then selling them. So who's going to be the buyer of last resort? The Fed. So you're going to create this vicious cycle. It's coming, and it's going to create hyperinflation at some point, and the US dollar is going to get creamed at some point relative to gold. And this is where you have to be very careful when you talk about dollar values versus other currencies. They're all like abstractions, all making the same mistakes. So you can't really value currencies against other fiat currencies. You have to value it against things. And the most valuable, scarce thing is gold, because it's also money. But what it means is inflation all around. And you're going to see inflation, and you're going to see inflation in the gold price.
That's kind of what we're seeing today, right? the U.S. dollar is strong, but it's strong against the euro and the yen. But
Yeah.
they're all depreciating against gold at the end.
Yeah,
of the day.
and the yen is in trouble, okay? And at some point, it's going to really unravel, and then Japan has to make a decision. They're going to say, okay, at some point they have to draw the line and protect the yen from really crashing. It's already gone down dramatically over the last 3 years. And that means they're going to have to sell treasuries, U.S. treasuries, to support the yen. That's going to compound the problem for the U.S. But that's coming because they have no choice. It's a ridiculous system where they bought everything, stocks, bonds. You know, the Japanese central bank owns most of Japan. I mean, it's ridiculous. Everything but sushi. And that is unsustainable. You can't do that forever. At some point, there is an inflection point where, as Hemingway say, things, how do you go bankrupt? Slowly, gradually, and then suddenly. And some event will take place, in my opinion, that's going to unravel a lot of things. And I don't know what that event. It could be a war, it could be another pandemic, it could be some financial collapse of a major institution, who knows? But there's always black swan events lining up everywhere. You never know when they're hit until the black feathers start flying. And that's going to happen. We've already seen the frequency of crises, the number of crises and the intervals between them are getting shorter and shorter. You saw with the 2008, and then you had the repo crisis, then you had the U.S. gilt crisis, then you had the U.S. the pandemic, then you had the U.S. Regional banking crisis. It's almost guaranteed that things will continue to break, especially with 5% interest rates. And they're going to continue to break, and the Fed's going to be playing whack-a-mole, trying to put out this fire and then that fire. And at some point, it all becomes too much. And this is where we're heading. And again, I'm going to go back to what I said at the beginning of this conversation. If you study history and you understand how these economies rise and fall, the patterns are all there. It's like someone's written you a playbook of how this is going to play out. And it takes an event to kick everything into gear, to unravel everything. And we're going to have a shock. It's going to be a shock to everybody in this room. You guys won't even see it coming. And you're going to go, how the hell did that happen? And it'll catch most people off guard. And most people won't be protected. They won't own gold. They won't be geographically diversified outside of, or asset class diversified into things that, can protect you. People are still playing the market like it's 1929. They keep, the wine is flowing and the music's playing and nobody wants to stop the party.
So the Fed's obviously trying to get inflation at 2%. Are you in the camp that they'll get inflation down, or is higher inflation here for longer?
They're only going to get it down if we have a hard landing. The only way it's going to get to 2% if you have a hard landing, and they're trying to avoid that, obviously. They may do it accidentally, but I think where inflation is here to stay. It's the only expedient way you're going to get rid of debt is to inflate it away, and that's governments love that. They're certainly not going to get rid of that debt through deflation. It only happens with inflation, and that's the oldest trick in the book. You run up your debts and you inflate it away, and you're paying back with cheaper dollars. So that's happening, and it's going to come in waves. You're going to, most of you weren't around in the 1970s. I was, and there were several waves of inflation that came out through it, and they got progressively worse as these phases came in and out. There's no way that the Fed can control inflation because a lot of it is out of its control. It's supply-side inflation, not demand-side inflation. So they're playing a stupid game of trying to kind of bring it down very slowly. And again, I'm going to say it, something's going to break. They can't keep these 5% rates up there for long. I'm surprised they've been up there this long. And you'll still see regional bank issues. You're going to see commercial real estate issues. The implosion of assets that are highly levered.
So one of the things I think that's confused a lot of people this year is you've had obviously strong equity market. The dollar's been strong. Rates have been rising. Real rates have been rising. Yet gold's gone up to record highs. I think we saw something similar in 2007. To me, it kind of looks like a bit of a canary in the coal mine. I think you've talked about that in the past.
I haven't. And again, this is the first time in as far back as I can remember, that gold is going up in the face of a strong dollar, a strong stock market, the concept that we're having higher rates, higher for longer, all of these things, reasonably strong U.S. economy, and gold still goes up. And I'll go back to what I said. It's because China now controls the gold price. And if China keeps doing what they're doing, the West, the Western vaults have been emptied over time and is all heading east. And a lot, like seriously, 50,000 tons in the last 25 years have gone from west to east, physical gold. And people need to understand that it's the physical gold you need to pay attention to, not this paper gold shit that you see, being traded here in North America. So yeah, no, I think that trend will continue. Yeah.
Well, I'll just mention it is actually interesting. We actually saw a period like this in the past. It was 2005 to 2007. Stock market did great. Interest rates rose, real rates rose. Gold was up 56% just before December 2007 when a recession started. So to me, that's a signal today that of a very similar period to that. So that's what I'm.
Yeah, and no one saw that coming either.
No, exactly.
It's like
the housing crisis was contained, right?
Well, it was. Again, never listen to what the Fed says. They've never seen any disaster, impending disaster coming. Never. You think about 2008, the system was working and the Fed was saying, everything's fine, housing market's fine, and then kaboom, one day it didn't work. Overnight, it just didn't work anymore, and they never saw that coming. 2009, 2010, Bernanke, we're going to unwind this balance sheet, this is just temporary, and here we are, 15 years later, they can't unwind it. 2021, transitory inflation, What transitory inflation? It wasn't transitory, it was structural. And so don't rely on the Fed to tell you what's going to happen. They're always going to say everything's rosy until it isn't. And the problem that they suffered, Fed chairs suffer from a thing called perceptual blindness. And it's a symptom that only goes away when they leave office. And then they can talk freely, as Greenspan has been talking freely, about things that he couldn't say when he was a Fed chairman. They have to go by the playbook.
So you mentioned back in early 2000s, people thought you were crazy talking about gold. I think gold has a bit more respect now, maybe a little bit more, not a lot. Gold's outperformed the S&P 500 for the last 24 years, including 13 of those 24 years. And yet gold, a lot of people still hate it. Warren Buffett's famous for not being a fan. You think that changes?
Yeah, by the way, you spelled my name wrong. It's G-I-U. Just noticed that. Oops. It's embarrassing. No, listen. Here's the problem, the CNBCs of the world, if you think about, and Wall Street in general, and the financial media in the US, has always hated gold. And the reason they hate gold is for two reasons. Number one, they can't make any money out of it, because how you should own your gold is you own 10, 15% of your portfolio in physical gold. That was a standard for decades up until 25, 30 years ago. And so if it's just something that sits in your portfolio, they can't, they can't sell you this stuff, and they can't make fees off of your gold holdings. So they've always hated that. And more importantly, it counters their narrative that everything's okay and you should continue to buy the shit that they sell you. And so, you always see it on CNBC when they talk about gold, and we took them to task recently, and we actually got a reaction out of them. Because on one day, they wrote an article when gold started to spike, suggesting that you shouldn't buy gold because if you do, you're voting for a doomsday scenario, and it's a horrible thing, and you should never, it's risky and this and that. And in the same page I was watching, there was an article on Bitcoin, how wonderful Bitcoin was going to go to 100,000 a coin, and blah, blah, blah. Because they make money on these, on all these other financial assets. And they can't make money on gold. So it goes against their narrative. And so first of all, anything that CNBC says, I think is complete and utter bullshit. I mean, Jim Cramer, you could hire a chimpanzee with a dartboard and do just as well as Jim Cramer with his picks. Now, there's statistical analysis on this. Somebody ran an analysis. He's usually wrong. Okay, but today the lines are blurred between what is investment, what's gambling, what's entertainment. And the CNBCs in the world are providing, they put on this Kathy Wood from ARC. I mean, she has been a disaster. She has lost her clients, $100 billion? And they keep putting her on like she's some guru. I mean, it's like having Fredo run the Corleone family. I mean, she's really, but they give her so much airtime because it sells the kind of ideas that they want to sell. They're trading the
AI.
And so that's, you have to go outside North America to really understand how the rest of the world sees what's happening here. And they see it very differently. They see, American hegemony as being, something they would like to see changed. They see this rules-based international order as complete hypocrisy and bullshit, and they don't like being lectured to. I was just watching. There was an interesting interview with the president of the DRC, which is the most mineral-rich country in Africa. He was being interviewed, and the interviewer was from the UK, and he said, what do you think of the Russians and the Chinese? He says, well, we like them more than we like the Westerners. He says, when they leave here, they leave as a hospital. When you guys leave, you leave with a lecture about human rights. And they don't like to be lectured to. And this is how the rest of the world is feeling. And so they don't like what's happening. And the US and the West tried to get most of the world on side with sanctions on Russia. People didn't play along. They were going, nope, sorry. We're going to continue. And what's happened is Russia's increased its trade with Iran, with China, and about 100 different countries since the war. So it's kind of backfired, this whole thing. And I think now you're getting this additional rhetoric about not only freezing their assets, but about seizing and selling their assets. And I'm telling you, that, as much as, whatever you think about Russia, whatever you think about anything, if the US does that, and does it in earnest, think about how the rest of the world is going to feel. Why would we hold a currency that you can cancel anytime? You can just cancel it, flip a switch, and it's gone. Why would you want to do that? And that's why you're seeing this exodus take place.
So on that point, de-dollarization, is that going to take a long time? Like, people are talking about a gold-backed currency. Gold is the third largest reserve currency in the world. Obviously, the US dollar is number one, the euro is number two. There's really no number four. Like, is gold-backed currency a thing in the future?
I think, again, I don't know. My guess is the way things are going and how they're getting rid of dollars and adding gold instead tells you something. The fact that China's made a number of moves. Here's what I think how it's going to play out. It could play out in a bunch of different ways, whatever this new system is going to be. In the short to medium term, you're going to see a mishmash of weakly dominant currencies being used, local currencies in bilateral trade agreements. And you're already seeing them announced every day, whether it's Korea with Indonesia or India and
Brazil?
No, it was Brazil and China, Brazil and France and China. There's a whole bunch of them. The UAE with India and dirhams. The UAE is courting 15 countries to trade in dirhams instead of US dollars. So everybody's finding bilateral trade agreements and settling them in local currencies. And what's going to happen, in my opinion, is that you're going to see all these countries introduce central bank digital currencies. And that's going to make that bilateral trade a lot more simple. And I don't know if you've ever heard of the M-Bridge project between China, Thailand, and the UAE, but it's been going on now for 2 years. They're testing the central bank trading system. In very simple terms, and I'm simplifying it, is you have two central banks, and they conduct the countries are conducting trade in just their local currencies, and they're going to use this digital currency. It's central bank to central bank will handle all Forex settlements on a ledger. And what's probably going to happen, and a possible outcome, is that gold's role in this is that when you have trade deficits, how do you settle a trade deficit with a country? Well, right now people are hoarding dollars. When there's a trade deficit, when the U.S. has a trade deficit with China, what happens? China buys treasuries. Mm-hmm. And that's how, they hold treasuries, and that's how they balance it out. But you're going to see, and several economists that I've talked to agree with this, that you'll have bilateral trade agreements settled in local currencies, and when there's a deficit, that net deficit will be settled with gold bullion. That's a simple way to get around the whole US dollar system. It's really simple. And you're going to see there's 130 countries right now that are experimenting with central bank digital currencies. And that's going to make the whole US dollar system seem antiquated. And it's going to be much faster, more efficient, and cheaper to settle trades outside of the SWIFT US dollar system.
I mean, ultimately, the U.S. is shrinking as the world grows. So it's kind of crazy for 80% of the world to run off the currency of one country. Anyway, let's switch to gold stocks or gold equities. Obviously, at this conference, there's been a lot of debate on, gold's at all-time highs, gold stocks are lagging. What's your thought on that?
Well, they're starting to catch up slowly. I always said I didn't think it was going to take this long. I was actually quite surprised that there's been this disconnect between the gold equities and the gold price. But I was saying all along, and I've said it for a number of years now, gold had to reach a new level and stay there before people truly believed enough that they're going to start buying into this sector. And it's just starting now that gold went through 2,300. You're seeing it now. I'm seeing the stocks that I own, and I've got a portfolio of senior gold producers that paid nice dividends. And so I've been watching them. And the seniors obviously moved first, and now the junior producers are starting to move. And next will be the developers, and the explorers will be last, obviously. But this is happening. And here's the thing, guys. I'm certain most of you in this room, a few years from now, are going to look back at this moment in time, and you're going to kick yourself that you didn't buy more gold stocks. And because they're going to go up, and it happens in every cycle. I've seen quite a few cycles in my lifetime, and I know how it works. And you're going to see gold's going to go do whatever it does, and the gold stocks and all of these, the juniors, the developers are all going to move, and they're going to move substantially, and they're going to move very quietly at first, and then they're going to at some point go parabolic. And you're all going to kick yourselves that you didn't buy it because you don't believe. And it's very hard to believe when you're sitting here and you haven't seen it for so long, you haven't seen a gold market for so long that you can't believe that it's actually going to happen and that these things will ever see the light of day. And I'll give you a great analogy of this. So in 2001, when I was doing Wheaton River, we struggled to create a $100 million valuation company with an acquisition we were doing. It was $100 million. We struggled with that. 10 years later, that company was worth $50 billion at its height. And that's an extreme example. Obviously, you're not going to see that often. But you will see stocks that today are trading at 75 cents will be trading at $10 and $15. And that's just how these cycles work. And these bull markets climb a wall of worry. And everybody, so the trick is to believe before everybody else believes. So believe now, avoid the rush, and it's just, but you have to understand why you believe that. And I have my own conviction about this, and it's going to happen. So I think the first part of the rally in the gold juniors will be a very small select number of investors that are forward thinking and really can see the writing on the wall and how this is going to play out. And it'll be a stealth rally, and then FOMO will kick in at some point. And then you get the people fearing that they're going to miss out, and then they're going to pile in. And at the end of the day, you get all the crazies that miss the entire run, and they buy at the top. And it happens in every sector. You've seen it happen with almost every other industry. So that's going to happen. And and mark your calendars. I said it here first. Let's talk about this a year or 2 or 3 or 5 years from now. And you're going to look back at today's prices and go, holy cow, I could have owned that at 70 cents or $4 or whatever it's trading at.
I think one thing now too is companies' balance sheets are in good shape. People are actually paying reasonable and sustainable dividends. Companies are focused on free cash flow. They're not blowing their brains out on huge acquisitions. So the sector is really in better shape than it was in the last cycle, but I think that's still massively underappreciated, no?
Well, 100%. And but again, and you're right. There's a lot of discipline in the mining sector right now because everybody got spanked badly after 2013 with all this craziness. The silly mergers and acquisitions took place. They spend the next 10 years writing all these things down. So everybody's very disciplined and watching their costs, and the investors are watching everything very closely, and the analysts are watching everything very, very closely. I guarantee you will see a frothy bull market where things go crazy, and when prices are a lot higher than they are now, and then that discipline will go out the window. So it happens every time, folks.
So when you're looking at a gold stock, what are the key things that you look at, and what are the key things that you would avoid?
I think management first and foremost. If you can have great assets and terrible management, and I really have to trust good managers. Shane Williams there of West Red Lake, I'm a big shareholder. Aris, Neil Woodyer of Aris, I built mining companies with him quite a few times in the last 20 years. So you trust the management. That's number one. I think number two is people have to understand community relations. And I think that there's been a lot of, over the years, I've seen a lot of arrogance in this industry in how they go into a community and don't establish those relationships with illegal miners or First Nations or whoever they have to deal with, and they blow it. So make sure you establish, like Eris, we have a really amazing community relationships with all the illegal miners. We brought them into the fold. We've made them partners. We train them. We educate them. We give them, the equipment they need so they don't pollute the environment. Blah 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 blah. And that's what you have to do. I think also you have to stay away from those type of management teams that like to hold on to everything forever and don't think about how to maximize shareholder value. They have their own little nest that they protect, and they don't want to do a merger or be sold or whatever, which is detrimental to investors, to the shareholders, because sometimes it makes sense. Most times it makes sense to put these things together and create something bigger. I think doing larger deals rather than small deals, and Lucas Lundin came out with a great line once, which I God rest his soul, he was a good friend, and he said, it's just as hard, I see you changed my name. Who did that? That's amazing. Thank you.
Digital technology.
He said it was just as hard to do a small deal than to do a big deal. So why would you waste your time doing a small deal? And I think that was a very astute thing to say, and I've thought about that. I tell all my guys all the time, let's not mess around with small deals. We're going to spend all our time, let's do something big. At least have a big plan for something small. Obviously, geographical risk is important, and I could argue that it's more risky in parts of Canada than it is in some other countries that I've operated in because of permitting. We saw this last panel talk about Ontario and Quebec, and that's why British Columbia, sometimes it takes 10 to 15 years to get something approved. In Latin America or West Africa, where I've dealt, 18 months, 24 months, you're going to get your approval. You go through all the steps. So I think geography and country risk is really important. So I think those are the main things.
So when you look at a Barrick or a Newmont, they're obviously on the biggest side of the scale, don't really have growth in gold. Is there really an investment case for those kind of companies versus just buying a mid-tier or buying the GDX, for example?
Listen, I own some of those companies. I own them because I believe the gold price is going higher, and they're going to continue. They pay nice dividends, and I'm going to get capital appreciation. I'm not really buying them because I believe they have a lot of room to grow. If I really want to make money, I'll buy a junior, which has the capacity, has a growth profile ahead of it, like Eris, which is the company that I'm a big shareholder of. It produces 250,000 ounces a day, but it's fully permitted and financed to go to 500,000 in the next 18 months. And it's got other projects that it wants to put into production. So you have the growth part of it there, and that's where you make your real money. And if you want to really take a little bit more risk and make a lot of money, buy the developers. Buy a really good developer with a management team, and watch it closely, and that's where a lot of money is made.
So you're involved with Wheaton River, obviously Goldcorp, that whole process of becoming a $50 billion company. Obviously, there was probably some lessons learned there on maybe what not to do or some of the things that didn't go well. Obviously, that cycle ended poorly. What are some of those things that you could do?
We did on that one there. We did almost everything right. It just was. It was like we like to say, it was lightning in a bottle. We caught lightning in a bottle. The timing was perfect. We were there first. And every acquisition we made, we proved the market wrong. We got a lot of criticism about overpaying for things, whatever. And we kept doing it. I think after I left the company, there was one major mistake, that one acquisition that they should have paid up for and they didn't, and it was really the beginning of the end of their high valuation. So, but for many years they did everything right.
So we talked a lot about gold. How do you feel about other commodities right now?
I like copper. I love copper. They're hard to find. Good copper projects are really hard to find. But I like copper. I love nickel. Again, very hard to find. Gold is easier to find than some of these other metals. But I like all of the critical minerals, or most of the critical minerals. And we in our group are looking at, lots of opportunities, and you have to go through a lot of stuff to find something that's decent. But yeah, no, I think that we're going to have a critical mineral shortage deficit in the next 5 to 10 years, and it's a serious one. And I had this conversation with the chairman of Rio Tinto, who's a friend of mine, and he said to me, I don't know where all this copper is going to come from. They know what the demand side is going to look like 5, 10 years from now, and no one has any idea where that copper is going to come from. So what does that mean? Copper has to go up in price to bring more mines into production. That's the only way you solve that problem. So I like copper a lot.
Also, I think you could probably make the case that, since, again, this cycle versus last cycle, companies are a lot more hesitant to invest. There's been a lot less investment in exploration. None of the majors are building new mines. At some point, that should feed into the price supply cycle, no?
Yeah, it will, 100%. And, for a decade, the majors certainly haven't done any exploration. The juniors have been cash starved, so they've done very little exploration. Something has to, obviously, higher prices will, funnel money into that direction. And again, I'm surprised it's taken this long, but you can see the signs of it starting now. And then I think, from the majors' perspective, they only have M&A to look forward to. They can't. They're way behind the curve in terms of finding their own deposits, and they never really did. Half of all the deposits that majors own were found by juniors. So, and I would think that going forward is going to be even higher than that, are going to be found by juniors because they haven't spent any money on exploration. So there's going to be a lot of, here's the thing you have to look forward to. If you own a junior gold producer that's doing well and has got a great growth profile, it's probably going to be a takeover candidate. Eventually someone's going to have to pay a premium to take that over, to make it something bigger.
Maybe we could just go back to the gold price for a little while. Any forecasts on where you see it going?
I don't forecast gold.
Forecast?
I think anybody that forecasts anything is either an idiot or just full of shit.
Well, you think 2000's a floor here?
Oh, I think we've found a new level. Now, listen, it can bounce up and down. Gold can be volatile at times, but I think we found this new level now, and it will trade within this range until something else happens. But I think the trajectory, if you look at it, like I bought my gold in 2001. I've never sold an ounce, my physical gold, and I bought more in 2018. And to me, that pile of gold, that physical stuff, why sell it? That's your insurance against all human stupidity. And so that's going to continue to go up. I really believe that. We must have talked real fast because we got through all the questions like with 14 minutes to go here.
Any questions from the audience? Go ahead.
Frank, so you mentioned you're a history buff. So I'm curious, looking back, what are some signals that the market might be starting to turn?
What do you mean turn in which way?
Like start to go up, like we might be seeing a bull run.
Oh, you're talking about in the gold stocks.
Yeah.
Well, it's not about, listen, markets do what markets do. But let's just talk about the gold price because that's going to dictate whether the other equity markets are going to go up. What I'm seeing is the classic mistakes that were made by the British, the Spanish, the Dutch, the Portuguese in 500 years of history. And again, Ray Dalio's book, you got to read it. He does a really detailed analysis of this. Here's how it starts. A global power matures, and then they overextend, and they have to pile on debt to maintain that growth. And then the debt gets way too high, so they have to print money. That printed money allows the elites to buy up all the assets, so you have the inequality grows. With the inequality growing, you get social unrest. You get sort of this, what you're seeing in the US today, where they're fighting over cultural things. And then while all this is happening, you've got an external force that's competing with a global power, or a combination of countries that are competing. In this case, it's China. But if you look at all the other countries and what they have, and they usually get into too many wars, the global powers, and they blow all their resources, treasury on wars, and it becomes unsustainable. And at some point, there's some form of conflict, and you have to define what conflict means, between that new rising power and the declining power. And again, you can chart it throughout history. They all make the same stupid mistake every time.
Any other questions?
As a student of history, what lessons can we all learn from the Weimar Republic?
Don't print money.
It looks like we're kind of heading in that direction. I'm just wondering, have you looked at what typical citizens were able to do to kind of hold on to value? I know farmers are doing great. They're still selling their produce at inflated prices, but
Yeah.
any lessons from
Yeah, the lessons are that you can't, when you're fearful of a high inflation or hyperinflation, you got to move out of financial assets into hard assets. Anything that's tangible, the more scarce that tangible thing is, the more it will go up in value. So if you look at the 1970s, Weimar Republic was a complete anomaly that, that really got crazy where, you needed 1 million Deutschmarks to buy a loaf of bread. And that could happen quite easily. But if you look at the 70s, you see that what assets performed during that 10-year inflationary period? Gold, farmland, okay? Those are the two big ones, gold and farmland. And then other stocks can do well in an inflationary environment as long as the system doesn't collapse. But financial assets, bonds, currencies, anything that's paper and not real, or a derivative or something, those things are going to get demolished. So I started protecting myself years and years ago, maybe a little bit too soon, who knows, but taking financial assets and putting them into hard assets and making sure that I was geographically diversified, because you never know what's going to happen. Pick a country, the US or any other country, and if things start to implode and you get a currency crisis, don't underestimate the lengths that those governments will go through to keep the system in place, including screwing their own citizens. And if you don't believe that, see what happened in 1933. In 1933, during the Depression, what did the US do? They said, okay, first of all, you can't own gold and you have to sell us all your gold. The minute they had everybody's gold, they devalued the dollar and repriced gold to higher. So they screw their own citizens. What else do? They create capital controls. And we've seen this in our lifetimes. In the UK in the 1970s, you've seen it in Greece. When countries get into trouble, they screw their own citizens by not allowing them to export their money out of the country into another currency or into anything else for that matter. And sometimes they'll freeze your bank account, like they did in Cyprus. And I think now what's legal in the US with the Frank-Dodds Act is that they can do bail-ins. And if you've never heard of a bail-in, you better look it up. Because the next crisis, if there's a major banking crisis, they can take any money that's above the $250,000 that's not insured, that's in your bank account, they can just take it away from you. It's called a bail-in. And that's legal and it's allowed. And so you can do a lot of things to protect yourself. Don't have more than $250,000 in any one bank account. That's simple enough. Have your money not only in one country. Have assets around, in different geographical areas. And have asset diversification too, because you don't know how this is going to play out. Does inflation, higher or hyperinflation, create a collapse and therefore a depression? Do you get a combination of both? So you have to be diversified, and because you don't know how exactly this is going to play out.
Any other questions?
Some of the work I've been doing along the lines of what you've been doing, Frank, is I've looked at Chinese holding of U.S. treasuries. It looks as if indeed they are gone from 1.3 trillion with 750 billion U.S. treasuries. But they seem to be just, from what I can gather, they seem to be just, as they mature, just not buying anymore. So that's one major buyer of U.S. treasuries is totally gone. And what I've also read is what they've been doing is not only investing in gold, but also in things they know they'll need. For instance, they're buying copper, they're replenishing their oil reserves, and they're just buying real hard commodities.
Yeah. And yes, they're doing all that. They're inventorying commodities. They're preparing for something. Who knows what they're preparing for? Yes, but you think about what China's done in the last 20 years. They've invested $1.3 trillion in 165 countries, 20,000 projects around the world. So they take those US dollars and go, well, instead of sitting on US treasuries, we're going to go and invest in real things around the world. So, you know, you go to Africa, I mean, it's incredible how much infrastructure they've created in Africa, and these are all investments. And so, yeah, they have to dispose of those dollars one way or another, you know, buy gold, invest in other things, but get rid of the treasuries, and certainly don't buy any more. And you're seeing, by the way, it's not just China now. You know, Saudi Arabia is not buying any treasuries anymore, so they're finding ways to kind of go elsewhere. But they have to be very careful because they're walking a very fine line between China and the U.S., and they have to be careful how they manage those relationships. But you know, they're not stupid, and everybody's taking precautionary measures to get rid of their dollars and be somewhat protected in the event something goes wrong. Yeah, Shane.
Just a question, Frank, before you had some great successes, what are your companies you're following now or involved in? What are the main newcomers?
Well, is that a loaded question? This is Shane Williams from West Red Lake Gold Mines, which I am a major shareholder of. Thanks for setting me up. West Red Lake, Aris Gold. You know, I just did a deal with Treasury Metals, which is a deposit in Ontario, just to control that. And I'm always looking for other ones. But my philosophy is you start with something small. If you look at all the major companies we've created over the last 25 years, you start with one asset, and through a buy and build strategy, you keep building and buying and acquiring, and you create a major gold mining producer. And that's always my objective. So when I get into West Red Lake or Aris or any of those things, the objective is get from whether it's 100,000 ounces or you start with 250,000 ounces, whatever you start with, get to 1 million ounces as quickly as you can. And this is what we're good at: M&A, capital markets, how to get there, how to engineer a company through both building mines, acquiring mines, and M&A.
So you talked about building companies or investing. It's early days, sentiment's low, prices are low. When do you sell out? What's the signs at the top?
Oh, the signs of the top.
Yeah.
Okay. when everybody's talking about it. So look at Bitcoin. I don't know if you remember the run on Bitcoin had in 2020 or 2021 when it ran up to 65,000 the first time. I mean, you couldn't have a conversation with anybody on the street without somebody talking about Bitcoin, how they own Bitcoin, and or some other crappy cryptocurrency that you've never heard of, Doge, all these stupid deals. When everybody's talking about it, sell. And that's
a long way away.
It's the old adage, when your taxi driver is giving you stock recommendations in a sector, sell.
All right, I think we're bumping up on 5 o'clock here, so thank you, Frank, for joining us.
My pleasure.
That was very informative. Thank you.
Okay, thank you.
Cheers.